So, there is some theory part and some practical part, some case study about the IPO. Okay. The IPO of Sula Vineyards, which came last year. So, I've just gone through that yesterday. So, I may be making a presentation there. And there will be a practical question from that part, okay, on your take home paper. So, you can see on the screen. So, we're talking about the rules, regulations, and the IPO regulations are given under regulation number 4 to 55, and FPO regulations are given 101 to 131. What I'm covering the classes are all IPO regulations, okay? But that almost the same regulations are applicable for FPO, but they are not that much elaborate. Maybe some things, because IPO is for the first time the company comes, and FPO when the company comes for the second time. So some of the regulations, some provisions are dropped there, okay? So you can just check that. I am only covering IPO regulations. So filing of offer document. We all know, whenever an IPO comes, the company has to come with a prospectus. It is called initially an offer document, okay? And regulation 25 and 123. So that means 25 is for IPO and 123 for FPO, okay? So prior to making an IPO oblique FPO, the issuer shall file 3 copies of draft offer document with SEBI with the appropriate fee, which has been which has to be filed with the help of the lead manager or the merchant banker. So that means the company has to file an application, file a offer document in 3 copies, a draft offer document with SEBI, okay, and they have to pay the necessary fees, and that is done with the help of the merchant banker. Then the issuer shall also file a draft offer document with the stock exchange. So that means first they have to file with the SEBI, and then they have to also file simultaneously a offer document with the stock exchange. Okay. So wherever the stock exchange where the issues are listed, they are supposed to file a offer document there also. Is that okay? And submit to the stock exchange the permanent account number, bank account number, and passport number of its promoters, where they are individuals. Okay, so if the promoters are individuals, so their PAN number, their account number, bank account number, everything has to be shown. I mean, filed with the SEBI, and a permanent account number. Now, it can be even a body corporate. The promoters can be just a body corporate. So in that case, they have to file the permanent account number, bank account number, the company's number with ROC, which the promoter is registered. Okay, so they have to file the details with regard to the company. Or the promoter is individual, then they have to give the permanent account number, bank account number. If it's a company, they have to file the company's particular. Okay. Now, the lead managers, who are the merchant bankers, shall submit the following to SEBI along with draft of a document: a certificate confirming that the agreement has been entered into between the issuer and the lead manager. So first, they have to file, a document with SEBI that there is an agreement between the merchant banker and the company who is coming with an IPO. So they should have an agreement between themselves, the merchant banker and the company who is coming with an IPO. A due diligence certificate, okay, that company has complied with all the disclosures and verified all the compliances which are required under the IPO regulations. So a due diligence certificate, okay. In case of an issue of a convertible debt instrument, suppose it is involving a convertible debt instrument, okay, like a bond to start with, and then it becomes share later on. So it's a convertible this thing. Then another due diligence certificate that which has to be from the debenture trustees, who are the trustees of the debenture. So they have to file a due diligence certificate from them, okay. Then SEBI may specify changes or issue observations on the draft offer filed within a period of 30 days. So the SEBI has to, they can, they can ask for some changes to be made in the offer document or some amendments. So that has to be done within 30 days. After you file an offer document, that means the company files an offer document. So within 30 days, SEBI has to, revert back with any changes they require to be made on the offer document. Now it is written that period of 30 days from the later of the following dates. Okay, so the meter starts 30 days starts from the date the offer document is filed, but subject to certain things. The date of receipt of the draft offer filed with SEBI. The moment the SEBI is going to receive, the 30 days going to start from that. So within those 30 days, SEBI has to come up with their comments and either give an approval or they ask the company to make some amendments. Okay, the date of receipt of satisfactory reply from the lead merchant bankers, where SEBI has sought any clarification or additional information from them. So, if SEBI asks for any, clarifications or any, more information, so the lead managers have to, satisfactorily reply that. So, 30 days will start from after the merchant bankers have given a reply to the SEBI's objections. The date of receipt of clarification or information from any regulator or agency where SEBI has sought any clarification. Suppose, SEBI can also seek, some kind of a clarification from the other regulators, like, Reserve Bank of India in case of a bank's, issues, or any other, IRDA or any regulator, they can ask for some more, information from them. So after they have received all the information, either from the merchant banker or from the regulator, okay, so and date of receipt of copy in principal approval letter issued by recognized stock exchange. So the stock exchange also needs to give an approval, um, in principle approval, that there is no objection if the shares get listed on the designated stock exchange. So the 30 days will start after the last event happening of which are the points given here. Okay. If SEBI specifies any changes or issues observations on the draft of a document filed with it, the issuer and the lead merchant banker shall carry out such changes and comply with observations issued by SEBI before registering the prospectus. So it's called the red herring prospectus or a shelf prospectus, okay, or a prospectus, depending upon what is the situation. Suppose the company is coming with a, book building process, okay, then it is called the red herring prospectus, where the price band is given. Okay, so we're going to discuss that today. So the fixed price is not given. So if the fixed price is given and company has met with all the, regulation number 6, clause 1, that they have necessary assets, net worth, operating profits. So if they are, a company which has a past track record in terms of good profitability, good net worth, which have been specified in the regulation. So in that case, it will be called prospectus because the company is going to come up with a fixed price issue. They may choose to come with a fixed price issue. It's not mandatory. Company can say, okay, we are going to issue shares say at 200 rupees, no price band. Okay. So they can do only when they have complied with all the regulations of SEBI with regard to profitability norms and asset norms. But they can come still with a book built issue. Okay. And book building issue is necessary when the company is not met the norms. Okay. Where they have to offer 75% of the shares to the QIBs. Okay. Zubain, can you read?
Draft of an offer document and offer document will be available to the public. The draft of a document filed with SEBI shall be made public for comments, if any, for a period of at least 21 days from the date of filing by posting it on the websites of SEBI and stock exchanges when the specified securities are proposed to be listed and lead managers associated with the issue. The issue shall, within 2 days of filing the draft of a document with SEBI, make a public announcement in one English national daily newspaper with wide circulation, one Hindi national daily newspaper with wide circulation, and one regional language newspaper with wide circulation at the place where the registered office of the issuer is situated, disclosing the fact of filing of the draft of a document with SEBI and inviting the public to provide their comments to SEBI, the issuer, or the lead managers in respect to the disclosures made in the draft of a document.
So that means the company has to file that offer document for public comments. So they have to invite public comments and publish those offer document on the company's website, give newspaper advertisements, and seek some kind of a opinion from the public. Okay. Yeah.
The lead manager shall, after expiry of the period stipulated above, file with SEBI the details of the comments received by them or the issuer from the public on the draft of a document, during that period and the consequential changes, if any, then are required to be made in the draft of the document.
So that means, the public has made some kind of comments and sought for some clarification. So all that should be given by the company and incorporated in the offer document before they can proceed ahead.
The issuer as a lead manager shall ensure that the offer documents are hosted on the website as required under these regulations and its contents are the same as the versions as filed in the registrar of companies and the stock exchanges that are there.
So that means, whatever they hosted on the website, all the offer document, that should be dicto of what they have filed with the SEBI and the registrar. Okay, further, Zubin.
The lead managers in the stock exchanges shall provide copies of the offer document to the public as and when requested and may charge a reasonable sum for providing a copy of the same.
So that means if the public wants more information, they want the offer document, the hard copy or a soft copy, the company has to provide them at a reasonable cost. Now, there is something called ASPA. Okay. Now, whenever we apply for an IPO, we have to give, as an investor, we have to give some money to the company, for investing into shares of the IPO or an FPO. So one mechanism through which the money is collected is called ASPA. So, which means, it is called application supported by block amount, where, earlier you were giving checks to the company, okay, and they were depositing in their escrow account. The account is called escrow because the company can't take any money out of it till the issue is, complied with, all the formalities have been done. Then the money gets transferred from the escrow account to the company's main account. Then they can use that money for, for the purposes for which they have, come up with an IPO. So now that system is gone. So it's now the new system, and rather even SBI has replaced now UPI. Okay, but it is SBI and UPI both go hand in hand. For certain investors, for retail investors, become UPI, and for other investors, other than retail investors, it is ASPA. Just read that.
The issuer shall accept bids using only the ASPA facility in the manner specified by SEBI. ASPA stands for Application Supported by Block Amount, which means an application for subscribing to a public issue or rights issue, along with an authorization to self-certified syndicate bank to block the application under the bank account.
So that means the ASPA facility, the SEBI gives to the self-certified syndicate banks. So there are certain banks which have been classified as self-certified syndicate banks. So these banks are authorized to go ahead and raise money through the mechanism called ASBA. Okay, and so the public is going to apply through the self-syndicate bank branches. Okay, so they have to file their application either online or in physical form into those designated branches. Okay.
Under ASPA process, instead of moving the application money from the bank account of applicant in an IPO to an escrow account, the same is blocked in the applicant's own bank account, and if he receives shares in IPO, the same is released to the issuer company.
Okay, so what does it mean, Shubhani? Shubhangani. So what does the last line means according to you? Just read the last paragraph. Just read it in your mind and tell me what does it mean. Have you ever, participated in IPO or FPO earlier? Anybody who has participated in a IPO so far? No. So just read the line and say, what do you mean by that? Okay. No idea? Zubin, can you make out what is written?
Sir, so instead of transferring the money to an external account, the blocking process ensures that once the shares are received, the money automatically goes to the issuer.
Yeah. So it says under ASPA process, instead of moving the application money from the bank account of an applicant, that means you don't have to give a money, okay, by a check. The money never gets transferred unless the shares are allotted. So it doesn't go to an escrow account. Escrow account is the account which the company has to maintain. Okay, fine. They can't draw any money from that account unless the IPO is fully subscribed and they have complied with all the regulations, rules, this thing, and merchant bankers certify that everything is okay. Then only the money will get transferred to the company's main account so that they can use that money. Okay. Same is block in applicant's own bank account, which means when you apply for an IPO under this facility, the money will remain in your account only. It will not move out of your account. Suppose you applied for shares and suppose you applied for 2 lakh shares, the 2 lakh will not be debited to your account, but your 2 lakh amount will get blocked. You can't use that money, okay, till the process is on, okay. Um, and if he receives the shares in the IPO, same is released. So if you receive the shares against the money which you have applied, which the money you have, given a mandate, the money which gets blocked will released, okay, when the IPO is subscribed and you get shares. So the money will go to the main account or the escrow account of the company, okay, or you may get refund if the shares are not allotted to you. The refund means that block will be removed. So there is no refund as such. The block will get removed so that you can use that money for your general purposes. Is that okay with everyone? Have you all got it? विराज विराज इज देयर वो बाद में अटेंडेंस लेता है ही इज ऑलवेज मिसिंग एंड ही इज टेकिंग द क्लास फॉर द सेकंड टाइम okay he took the class last year also and he said that I want to gain more knowledge and he's missing. Okay, individual investors can use UPI for up to 5 lakh payment in public issues. So that means UPI is applicable up to 5 lakhs. So all investors who are making applications around 5 lakhs or thereabout, they can use UPI. Individual investors applying in public issues of equity shares and convertibles can use UPI for application amount up to 5 lakhs. The same system as ASBA, the money you use UPI and your money gets blocked there. And it will get only released when the shares are allotted to you. Okay. But now UPI has become mandatory. So this is the latest amendment which has happened. UPI is now mandatory. In use of a UPI as a payment mechanism in public issues mandatory. So question is this: yes, UPI mechanism is mandatory for all the applicants made by individual investors through the intermediaries provided the application amount is up to 5 lakhs. So all the people who are applying, individual investors who are applying up to 5 lakhs can use UPI instead of ASPA. All the categories of investors eligible to apply for public issues using UPI payment? Is it applicable to everyone? So there are 4 categories. Okay, I'll just talk about them, though I've talked in the last lecture. No, only individual investors are allowed to use UPI for payment in public issues as retail investors and non-institutional investors. So there are only 2 people or 2 sort of investors who are allowed to use UPI. Okay, so there are 4 categories. One is called the retail investors, whether they are retail individual investors or retail investors, shareholder investors who are already shareholder of the company, they are again applying, or they can be anchor investors, okay, who can't use UPI, or they can be qualified institutional buyers. Those 13 big institutions who can participate in public issue. So these 2 people, anchor and qualified institutional buyers, they are not permitted to use UPI. Only the NIIs and RIIs. R means retail institutional investors, RII, and NII, which is non-institutional investors. So, there are 3 main categories. One is the retail investors, qualified institutional buyers, anchor investors. Anybody who is not falling among any of the 3 is called the non-institutional investors. So that's a definition given by SEBI. Fine. Now, whenever a company is coming with an IPO, they have to deposit a money with the stock exchange. It's called a security deposit. So that, because it involves times of stock exchange, okay, company time gets involved, merchant bankers time can involved, SEBI's time gets involved. So you have to be serious if you're coming with an IPO. So the stock exchange collects a security deposit and gives it back once everything has been done. Just read this, Zubin.
The issuer shall, before the opening of the subscription list, deposit with the stock exchange or stock exchanges an amount calculated at the rate of 1% of the amount of the issue size available for subscription to the public in the manner as may be specified by SEBI, and the amount so deposited shall be refundable or forfeitable in the manner specified by SEBI.
Okay, so how much? 1% of the amount of the issue size. Shubhangni, please come here because I would ask to read. Okay, your voice gets recorded, and it's I mean Zubain and you are both. Okay, fine. So just come in front. Okay. So that means a security deposit needs to be deposited. How much? 1%. Okay, it will get released after the IPO process is completed and it is successful. Then opening of an issue. So once the offer document is approved by SEBI, now there comes the opening of the process. A public issue, both IPO and FPO, may be opened within 12 months from the date of issuance of the observations by SEBI, which means SEBI has observed, okay, and they have given their clearance. It means that. So within 12 months after the nod of the SEBI, a company has to come and open the issue. Normally, the company will do immediately, okay, but maximum time it is given is 12 months. After 12 months, the approval gets expired. So normally, the company is just waiting for SEBI's approval and they go immediately with that, okay. But maximum time is 12 months. Read, Subhagini. In case of fast-track issue, the issue shall open within the period specifically stipulated under the Companies Act and Hospital. So, there's something called fast-track issues. We will be learning that later on. So, because, there's a lot of time which is gone through, complying with all the formalities of SEBI, stock exchange, everything. So, there is a fast-track issue process. It is only for established companies and the companies who are legally compliant. There no case pending. So we'll talk about that when it comes. So for those companies, a fast track system has been coined so that they can come up very fast with an IPO or an FPO. Okay, rather it will be applicable for an FPO mostly because the company coming for the first time, they may not have a track record to talk about, and the track record has been specifically stipulated under the Companies Act 2013. Okay, fine. It's not in ICDI regulation. It is in companies the act also. There's a mention there. Okay. In case the issuer has filed a share prospectus, the first issue may be opened within 3 months of the issuance of the observations by SEBI. Now there are various terms like shelf prospectus, red heading prospectus, like that draft offer. So the shelf prospectus is applicable only to the banks. Okay, fine. Only the banks or financial institutions, they make a shelf prospectus because bank may need a lot of money every time. Okay, so they file a shelf prospectus. Okay, once for all, and then that the thing is filed. Okay, so shelf prospectus for that. People at the back, please. At the back, please come in front here. One of you. Aji यहाँ पर. Ever since I'm seeing you're talking to each other. What is shelf prospectus, by the way? What's your name? क्या नाम है? क्या नाम बताया? शक्ति. आपको भी नहीं सुनाई दिया वहां से? ओके, तो इसका मेरे काम में कोई प्रॉब्लम नहीं है. ओके, शक्ति, you are powerful, we know that, but you don't know what is shelf prospectus. So your class participation is 0. Shakti, though the name is very powerful, but 0 marks for your class participation. That I've noted. Unless I see a big change in you. Okay, fine. Just move here and participate in today's lecture. Come here. Idhar aa jao. Only then I will just remove that 0 from you. Okay, fine. Okay. Okay, read this. Opening of the issue. An IPO and an FPO shall be opened after at least 3 working days from the date of registering the red herring prospectus in case of book build issue or the prospectus in case of fixed price issue to the registrar of company. So this is the main regulation. Okay, fine. An IPO and FPO shall be opened after at least 3 working days from the date of registering the red herring prospectus. So that means, it is within 3 days. Normally, a company will come up with an issue. So they are given after the SEBI has registered a prospectus. Okay, whether it is a red herring prospectus or a prospectus, whatever it is. So they have to wait for at least 3 days before they can open the offer. So if you see any public issue, it's immediately after 3 days the company issues the open. So this is the main provision. An IPO and an FPO shall be opened at least after at least 3 working days from the date of registering the red herring prospectus. Okay. So what is a red herring prospectus? Shubhangini, do you remember that? Red herring prospectus. Simple. I mean, you should not forget it. Anybody? Yes. What is red herring prospectus? What is, no, no, I'm not asking you. Red herring prospectus where the price is not decided. The price band is given. It's a normal case, where the company comes up with a price band instead of giving a fixed price. That is, at this price, we are going to issue the shares. Okay. Now, only those companies can come with a fixed price if they have met all the norms, profitability norms. They have a net worth, they have operating profit, they have net tangible assets. Okay, all those things which are there, you have. I mean, today only you have watched the videos. So, if you have met and complied with all the profitability norms, then only you can come with a fixed price issue. Of course, the choice is there. You can still come with a book built issue. Okay, so in that case, price is fixed. I mean, the company can fix a price, but nowadays companies are choosing to give a price band. And who decides the price band? The company and the merchant bankers. Okay, so it's called red herring prospectus in the case of book built issue. So in case of book built issue, it's called red herring. Okay, or the prospectus in case of fixed price. If it is a fixed price, then it's called a prospectus straight away. Okay, it's not called red herring. Because in red herring, it's marked red. Because so far we don't know how many shares will be issued at what final price the company is going to issue the shares to the public. Is that okay? It's a very important thing and you should remember it all the times to come. Next time I ask you this question, you should be knowing it, okay? Fine. I should have all the hands raised that you know red herring prospectus. Otherwise, I'll feel that there is no point telling you because such an important, such an important topic. People pay lakhs of rupees to get this knowledge. When the first time I was handling an IPO in my case in a company where you came up with an IPO, Idea Cellular. So they were picking up people who had some knowledge. At that time, very few people had a knowledge about all the provisions of an IPO and SEBI regulations. So, they were in demand, and anybody who has knowledge, you will get a good. You always want to join companies and earn good money. So, this is one gateway to that. Okay. So, if you don't want, it's okay. It's you. Okay. Underwriting. Now we come to underwriting. Underwriting, I'll just explain, and she's going to read. Whenever a company is coming with a share issue, now if the shares are underwritten by the merchant bankers, okay, which means the public is confident that the shares have been underwritten by the merchant bankers. So in case if there is a lukewarm response, the underwriters are going to absorb the shares. Okay, so shares, issue will never able to, get, it will not fall. It will be subscribed by the underwriters. So when the public knows the shares are underwritten, they think that if merchant bankers have already given their mandate, so they'll apply it. If no underwriters come, then public is not going to give shares money to the company. Okay, read. Okay, it's self-explanatory that underwriters are basically accordance with SEBI regulations. Okay, yeah. So the who underwrites the lead managers. Lead managers nothing but merchant bankers and the syndicate members. Now they are syndicate members and the merchant bankers, okay, who are the associates of the merchant bankers. They both take the responsibility of underwriting the issue. Okay. So in case the company is offering 75% shares to the QIB, that means the qualified institutional buyers, that means it has not met the criteria, the profitability criteria, then it has to give 75% money has to be subscribed by the QIBs. That means the SEBI says or the government says you can take money. Maybe that you are not profitable, you don't have the number of tangible assets, or you don't have net worth. Okay, you can still go with an IPO like a company like Zomato or Paytm. So they were in huge losses, okay, but they still came with an IPO. So it's called the alternative method of raising money from through an IPO process. So in that case, 75% of the money has to be subscribed by the institutional buyers who are called QIBs. And there are 13 such institutions which have been classified as QIBs. So the majority of the money should come from them. Only the rest 25% should be from the public. Okay, not more than that. So in that case, 75% is through QIB, which may not be required to be underwritten because the monies will be given by the financial investors. Okay, so in that case, you don't have to underwrite that because they're large institutions. So then the merchant bankers will not be required to underwrite that portion of the, portion of the IPO which has been guaranteed by the QIBs, or rather QIBs are participating in that. Okay. So, there are two sets of people, the lead managers and the syndicate members. So, there has to be an agreement being made by the company with them. A specified price has been fixed for them. Okay. And in the event, if, there is an undersubscription of the issue, in case if there is a lukewarm response to the public issue, then agreement has to be made before that at what price they are going to pick up the share price or shares. Okay. So the main duty is of the lead manager or the merchant bankers. If the syndicate members back out, then the merchant bankers can't back out. Okay, so they have to take the shares. Anji, what is? So who are syndicate members? Okay, I'll cover that. I have already covered that in my video. Okay, so you can watch that. But during the break time, after I've covered, I'll just show you who are the syndicate members. Okay. So they will not participate in an IPO, okay, the lead managers and the syndicate members, okay, except for fulfilling their obligations. So I'll just take you to syndicate members straight away, though I have shown that earlier. All the definitions are given at the back. Okay. Syndicate member. So syndicate member, just read. So basically, syndicated members are nothing but, branches, banks. Okay, fine. And who can, along with the lead manager, merchant bankers, they can also participate in underwriting. Okay, but their main job is to collect the bids. Okay, and help in the process of an IPO along with the merchant bankers. Okay. Okay, यहाँ तक हो गया था. We have done it. Now underwriting. Okay, fine. This also we have done. Okay, so this is that, this you can just read. I'm just skipping that. Minimum subscription. How much money should be collected by an issuer, at least, to qualify as a minimum subscription? Okay, read this. So at least 90% of the money should be collected through an IPO process. So if that is correct, it's called the minimum subscription. So this clause says that at least 25% of the money should be collected from the public. Okay. Of the 90% which has been collected by the company issuer, 25% should come from the public, from the general public. Okay. So that's the second set of regulation. Okay. So we'll soon learn that at least 25% of the issue size, the money should come from a public. Okay. So there should be at least 25% participation from the public. Okay. Oversubscription. Now it may happen that normally it happens. Normally a company comes in IPO, the share issue is oversubscribed. Sometimes it is oversubscribed 10 times, 15 times, 20 times, 30 times. Company requires 1,000 crores, but they have got 20,000 crores. So it's called oversubscription. Now, can the company retain all the amount? No, company can't retain. Only 1% they can retain. Suppose you have come with a public issue for 100 crores and you have got 200 crores, you can collect only up to 1%. That means 101 crores. But that too for a purpose. Because there is a minimum lot size. Whenever public is applying and the shares are being issued, so there is a minimum lot size. To comply with that lot size formalities, if the company has to use some more money, they can do that. Read this. So only for meeting out the minimum lot criteria, they can issue 1%, they can retain 1% of the public issue they have got, they can retain that money, not more than that. Now, if you can look at this chart, of certain IPOs which came in past, Devyani International, Devyani International, which is this company? What it sells? Anyone? Devyani International. Devyani International. We always eat their products, which are not very healthy. Okay, Pizza Hut, KFC, they are the franchisee in India of this thing. Who said? You said? Yeah. So Devyani International, is that why it is? I know it's so this thing. Of course, it's a Pizza Hut. Everybody knows, but I have got a place which I have given to Pizza Hut, and I have an agreement with Devyani International for giving that place on rent or commission. Okay. So they came with an IPO for at a price of 86 to 90. So this is the price band. So the price range was 80 to 90 when they came with an IPO. Okay. And it was an IPO oblique OFS. So it was an IPO oblique OFS. What's the meaning? What is the full term? What is the meaning of IPO? First of all, IPO. What is OFS? Offer for sale. That means if the existing shareholders are offering for sale, okay, their own shares. Okay, if suppose I am a very big already a shareholder, I can offload my shares through an IPO process, and it's called OFS. Okay. Now, issue type 100% book building. Who were the merchant banker? Motilal Oswal. Lot size was 165. So every company has to decide about their lot size. This is the minimum a person can apply for the shares. Okay, 165 shares minimum. Then you can apply in lots. For a retail shareholder, the limit is 2 lakhs. So he can apply for 10 lots, 20 lots, depending that he's not breaching the 2 lakh limit. Okay, fine. So then there is a monitoring agency. Okay. So that means the SEBI has said that all the IPOs would be monitored. Okay, fine. Read that. So when it is monitored, if the issue size is above 100 crores, who monitors? The credit rating agencies like ICRA and CARE. All these are credit rating agencies who monitor an IPO only when the IPO is above 100 crores. And what is the time period? Yeah. So what they are monitoring, whatever amount which has been collected by the issuer, that has been spent for the purpose it has been collected. Suppose I came with an issue of 100 crores and I said I'm going to buy, building, plant, equipment worth 90 crores and 10 crores I'm going to repay my loan. So the monitoring agency has to make sure till the last penny is being utilized for buying plant, machinery, building, whatever has been mentioned in the prospectus, and they have paid the loan. They are going to give their report to the issuer. Issuer is going to share with the shareholders and with the SEBI. Now we come to the allotment procedure. So this is very important. Allotment procedure. How the shares are allotted once the money is received by the issuer or the company. Read.
Allotment procedure and basis of allotment. The issuer shall not make an allotment pursuant to the public issue if the number of prospective allottees is less than 1,000.
So the number of allotted should be not less than 1,000. Okay. So if they have received applications for only 500 people, then they can't allot any shares. It has to be minimum 1,000. Okay. Further.
The issuer shall not make any allotment in excess of the specified securities offered through the offer document, except in case of oversubscription, for the purpose of rounding off to make a lot, in consultation with the designated stock exchange.
So that means if they receive more money, they can't use it except for the lot size, for meeting out the lot size category, but with the help of the stock exchange. Okay. Okay. Yeah.
The allotment of specified securities to applicants other than to retail individual investors and anchor investors shall be on proportionate basis within the respective investor capital.
So this is very important. The allotment of specified securities to applicants other than the retail investors and the anchor investors shall be on proportionate basis within the respective investor categories. So there are four categories, which are four. First is called the institutional investors, which are QIB. Second is the NII, the high net worth individuals. Okay. Third one is retail investors, and the fourth is anchor investors. So these are the four kinds of investors who participate in IPO. Now, only for two people, it's a proportionate this thing. Who are them? They are basically the anchor investors. Sorry, they are basically the QIBs and NIs. Only NII and QIBs. Now, suppose the company has received a lot of money. They can't allot all the shares because otherwise, they will be collecting more money than what they have, they have, they come from the IPO. So they can't keep the oversubscribed money. So they have to allot, okay, through on a pro rata basis. Suppose if I have if suppose the issue size is 100 times oversubscribed, for example, 100 times or 10 times, okay, I made an application for 100 shares, I'll get only 10 shares, proportionate. Because company has received 100 rupees against 10. So if I have, applied for 100 shares, I'll get only 10. That is called the proportionate. Is that okay? Have you got it? It's a proportionate allotment. सबको मिलेगा, but on proportionate basis. Fine. But in case of retail investors and anchor investors, it is basically a different rule. Okay? It's not on proportionate. So we'll understand that.
The allotment of specified securities to applicants other than to the retail individual investors and anchor investors shall be on proportionate basis within the respective investor capital.
So the first one is explained. It will be on the basis of proportionate. Okay? जितना टाइम ओवर सब्सक्राइब हो उतना के हिसाब से सबको प्रोपोर्शनेटली मिल जाएगा. Company needed only 100 crores, but they have got 1,000 crores. So all the people will be issued shares up to 100 crores on the proportionate what they have applied for. Okay.
And the number of securities allotted shall be rounded off to the nearest integer, subject to minimum allotment being equal to the minimum application size as defined and disclosed in the offer document.
So it will be there will be rounding off will be happening to the nearest whole number. Okay. So integers are whole numbers. So in the process of issuing shares to all the four categories, now it may happen that the oversubscribed part up to 1% can be used for that because they are rounding off and it may require some more money to be retained by the company. It can be only up to 1%. Okay. Subject to minimum allotment. Okay. So minimum allotment lot size जो है उसके multiples में होगा. Okay. Now, however, the value of the specified security allotted to any person except in case of employees in pursuance of reservation made under these regulations shall not exceed 2 lakh rupees. Okay. So the maximum allotment should be below 2 lakh for retail investors. Okay. And up to 5 lakh for eligible employees. So if they're employees of the company, maximum it can go to 5 lakhs, but the retail investors, it will be 2 lakhs. The allotment of specified security to each retail investors, okay, so this is very important, shall be not less than the minimum bid lot. subject to availability of shares. Okay. Now, all the retail investors should get at least one lot. So that is what the SEBI says. Suppose as a retail investor, I have applied for 2 lots or 3 lots or 4 lots, but the company has got a big response. So at least one lot should be given to each retail investor, subject to availability of shares. अगर उतने share ही नहीं है, if there is a just like for example, IRCTC, they came up with 111.91 times whatever money they required, they got 112 times more money. So even if they have allotted one shares to all the retail investors, they would have not been able to do that with the entire of the public's thighs. Okay. So in that case, what will happen? Subject to in retail investors, and the remaining available shares, if any, shall be allotted on a proportionate basis. First, it has to be one lot minimum. अगर कुछ बचते हैं तो proportionate basis. As in the case of other investors, proportionate दिया जाएगा. Otherwise, there will be a lottery. Okay, suppose if they have to be issued one lot, and the company doesn't have that shares to issue because it's fully oversubscribed 111 times in case of IRCT. They'll pick a draw of lot and give one lot to only successful bidders. Okay, will be only by a draw of lots in that case. All the retail investors will not be issued one lot. Whosoever applied, though the SEBI says one lot should be given, but since the company doesn't have so many shares, because company can't keep all the money with them, so they will make a lot. Okay, they will specify how many shares have to be issued as per the category, what the shares have been reserved for them. So they will make a lottery and give one lot to each of them who are successful. Okay.
The authorized employees of the specific stock exchange, along with the lead managers and the registrars in the issue, shall ensure that the basis of allotment is finalized in a fair and proper manner.
So somebody has to, say to the stock exchange, to the SEBI, that the fair process has been observed for allotting the shares, and it has been done exactly what has been stipulated under the SEBI regulations. Okay, so they are going to say that. Okay, read.
Allotment, fund and payment of interest. The issuer and lead managers shall ensure that specified securities are allotted and all application monies are refunded or unblocked within such period as may be specified by SEBI.
Okay, so the lead issuer and the lead manager, they will ensure that the specific securities, that the shares are allotted or an application money are refunded in case if there is a refund involved. First, if you are successful, you will get a shares in your demat account, or if the company has received excess money, so they are going to release that UPI mandate, or sometimes they are going to give refund of money also in case of anchor investors who are given the money and they have received more, so they have to refund. So either it will be a refund process or unblocking of the ASBA or UPI mandate or allotment of shares. Any three things can happen. Okay.
The lead managers shall ensure that the allotment to any of dematerialized securities refunding or unblocking of application monies as may be applicable are done electronically.
So all this process has to be done electronically. Shares are given in demat account, so it's called dematerialization security. Refunding, unblocking, everything has to be done electronically, digitally. Nothing through a manual process. Okay.
Where specified securities
Now, upar, allotment, refund, and payment of interest. Now, in case if there is a refund to be given to the prospective investors, who can be of any category, now they have to be paid within certain period. The money has to be given to them. If the company fails to give that, they have to give 15% interest. Read.
where specified securities are not allotted and the application monies are not refunded or unblocked within the period stipulated by the Act, the issuer shall allocate to pay interest at the rate of 15% per annum to the investors, and within such time as visible in the offer document, and the lead manager shall ensure the same.
So company has to pay 15% rate of interest. If they fail to do their responsibility, if they take more time to unblock the people's money, because the people will not be able to earn interest on that because the money has been blocked. Okay, so they are going to pay 15% interest on that. Okay. Okay, so so I'm just going to you can just read it. Release of subscription money. Then what happens if the issue is fully subscribed? They have complied with all the regulations. Then the money should be released to the company from the escrow account to the main account, so that they can use that money for the purpose it has been. So this is given here. Okay, so I'm just, so there's some days specified. Okay, I'm just moving a little faster now. Okay, the issuer and every director of the company who is in officer in default on from the expiry of 8th day be jointly and severely liable to repay the money with interest at the rate of 50%. If the company, I mean, the delay is beyond the days stipulated in the this thing by the SEBI, then the employee, the person who is default, he has to pay it from his personal pocket. Okay. The lead manager shall ensure that the money received in respect of issue are released to the issuer. So, which means the company will be finally, the money will be finally released to the issuer after the lead manager ensured the company has gone through all the formalities. Now we come to the main topic. Okay, fine. So we'll just cover this a little bit and then we'll have a break. So after 10 minutes, we are going to have a break. 12:10, 12:10 to 12:30. Okay. Pricing. So this is very important. Just read.
Pricing.
Please focus here because the main question in your exam will be coming from this part of it. Okay.
An issuer in an IPO can regularly determine the price of specified securities offered to the issuer. Read the merchant banker after the book building.
So it's a main job of the merchant banker to advise the company at what price the company should go ahead with, for an IPO. What should be the price band? Okay, so this is a very, very important for you, all of you, because it's a job what the merchant bankers are going to do, and maybe that you may join any bank who would be involved in such process. Okay, so this is the most important part. So an issuer, and okay, this we have done. The IPO offer, I'm going to read this. The IPO offer to the public in primary market can be made through fixed price method or book building method or combination of both. So company can choose any method depending upon what company, what kind of regulations do the companies, I mean, complying with. Okay, so you can go with a fixed price method where it has a company which has a good track record in terms of profits, in terms of net worth or whatever, or it can go with a book built issue. Okay, in case the company doesn't have a good track record with terms of profitability, but a company can still go with a book building issue. That is up to them. Okay, even if the company is having good net worth, they can still go with a book building or a combination of both. Fixed price issue. In a fixed price issue, the issue price is already decided by the issuer and mentioned in the offer document, which becomes a prospectus. Okay, at the time after the SEBI gives the approval. Book building issue. Now comes the book building. Okay, book building issue is a type of issue where the investors bid for the issue price within the price band. Now here, the applicants are going to make a bid within the price band, which the company has stipulated. And the final price is determined only after the closure of the bidding period. After the bidding period is over, all the bids are received, then company and issuer and the merchant bankers, they're going to analyze and allot, fix a price, make a, go for a price at which the issue will be made. Okay, which process which we have already learned in my last section, or watch a video, you can understand that. Differential pricing. Can a company charge different prices from different prospective investors? Okay, not, they can't do that. Okay, but in certain cases, an issuer may offer specified securities at different prices subject to following. Retail investors, they can be given 10% discount. Okay, 10% discount. Retail investors can get 10% discount. Okay, but there should not be any incentives given by the merchant bankers or anyone for people to induce for going for an IPO. So no incentives are permitted by SEBI. You can't say that we'll give you a motorcycle or a radio or a TV or something like a laptop if you apply for an IPO. No such thing is allowed. Only a 10% discount can be given by the company if you are a retail individual investor. In case of a book built issue, the price of the special security offered to an anchor investor shall not be lower than the price offered to the other applicants. So anchor investors cannot be given any discount. Whatever price has been charged to the others, they will get at that price. Differential pricing. Now, whenever a company is coming with an FPO or a rights issue, company will come after an IPO. Company is doing business. Company needs more money. So whenever a company needs more funds, they have to first go to its shareholders. That's called the rights issue. They have to offer the shares to the existing shareholders. But sometimes the company may require a huge amount of money. The existing shareholders may not give all that money. So company can come with a composite offer where they are giving shares to the public as well as to their own equity shareholders. It's called the composite issue. Just read this.
In case of direct trade, an additional condition is that in case of a composite issue, the price of the specified securities offered in the public issue may be different from the price offered in direct issue, and justification for such price difference shall be given in the offer document, and
So
it
yeah.
shall be expressed in the complete terms in the offer.
So if you are an existing shareholder of the company, you can be given a certain discount compared to the issued price which has been offered to the public. But there should be a complete justification why the existing shareholders are being offered a lower price than what the company is offering to the general public. Okay, that the existing shareholders can be given a discount, but with a sufficient reasons for that, and that should be disclosed in the offer document. Price and price band. Okay.
Price and price band. The issuer may mention a price or price band in the draft prospectus in case of a fixed price issue and floor price or price band in the red herring prospectus in case of a booklet issue and determines the rate.
Okay, just. So the issuer, now this is very important though, we are heading for a break. Just a couple of more minutes, okay? The issuer may mention a price or a price band in the draft prospectus. Now they can mention a price or a price band, okay? In case of a fixed price issue, if it is a this thing, and a floor price or a price band in a red herring prospectus. So the company may come up with a price band from between 100 to 120, but they can mention the floor price in the prospectus without specifying the band. They can do that. Okay.
And determine the price at a later date before registering the prospectus with the registrar of companies. However, the prospectus registered with the ROC shall contain only one price or the coupon rate as the case may
So
be.
later on, they can decide about what will be the price, full band. Okay. Okay. So I'm just taking here the cap on the price band and the coupon rate in case of the convertible debentures. Okay. And just let me and determine the price at a later date before registering the prospectus with the registrar of the companies. However, the prospectus registered with ROC shall contain only one price or the coupon rate as the case may be. When you are registering the prospectus and finally the red herring prospectus becomes a prospectus on the day when the issue price has been fixed after the price band has been advertised into the public, people have applied for the bids and the merchant bankers decide that this is going to be the cutoff price. So then the company needs to file a prospectus. So from red herring, it becomes a prospectus and it is filed with the registrar. So at that stage, the price needs to be mentioned in the prospectus. Full price, the issue price. Okay.
The cap on the price band and the coupon rate in case of a convertible debt instruments shall be less than the full 120% of the
This is
principal
very
amount.
important. Now, the company may come up with generally a company comes with a public issue of a shares. So then the price band is there. Company may come up with the issue of bonds, which will have a coupon rate. Okay. So that's why coupon rate is mentioned here. Now, the whenever equal to 120% of the floor price. So there is a floor price, okay, and there is a upper band. So there is a price band which will have a lower end and an upper end, okay, and maximum it can go. Say for example, it is 100, then maximum it go to 120. So 20% more can be the price band. So if you are offering for 200, the upper band will be 240. If you are offering the shares at 300, then the upper band will be 360. So maximum they can go up to a price band has to be between 20%. Is that okay? Fine. Now, price and price band revision. Now, the price band can be revised. Okay. Once the offer is open, the company finds that there is a very lukewarm response. People are not applying. Okay. So they can say, okay, we are going to make a change. We are going to revise it downwards 20%. Or they can even revise upwards to 20% because everybody is applying at the highest price. So company may feel that people are so happy with the price that they find the price very cheap. So they may revise the price band by 20% upper band or 20% lower band. Just read this.
The price band can be revised to make a better deal, provided the maximum revision of
Is that okay? Fine.
That is, tomorrow the price band and move up or down with the extent of 20% of floor of the price band disclosed in the red herring prospectus.
Is that clear? So once the price band has been decided, the company goes with a public offer. I mean, the issue becomes open, and they're finding that there is a very lukewarm response. People are not. First day has gone, they got hardly any money, so they may say that okay, we are going to revise the price band. Suppose they offered between 100 to 120, so they say that we'll make it to 80, okay, so that they can revise down, and then the upper band will get automatically revised because it can be only 20% more than the lower band. Okay, so either they can revise downwards or they can revise 20% upwards. If they're finding everybody is applying for and there's a huge response, okay, so they can change the price. Fine.
Price and price band. The floor price or the final price shall not be less than the face value of the specified
So
security.
never the price of the shares which are offered to the public can be below the face value. If the face value of the share is 10 rupees, they can't offer for 8 rupees, isn't it? The band cannot start with 8 to 10 like this. Okay, so that is there. But last slide.
Price and price band. When the issuer ought not to make the disclosure of the floor price or price band in the preliminary prospectus, the issuer shall announce the floor price or price band at least 2 working days before the opening of the bid in case of an initial public offer, and at least 1 working day before the opening of the bid in case of further public offer, in all the newspapers in which the pre-issue advertisement is first released.
Okay, so if the company has not still undecisive, they have not decided about what will be the price band. So they can at the time of issuing the red herring prospectus, they can hold that information, but they have to give that information at least 2 days before the opening of the bid. Okay, and they have to give it through the newspapers in that case because the prospectus has been already filed and they have not given the price band or the upper cap or the lower cap, so they can just remain like that and do it 2 days before the IPO opens, or if it's an FPO, then at least 1 day before the FPO opens. But all this information should be given to the prospective shareholders by making an advertisement in the newspapers. Okay, and that's called the pre-advertisement. uh, um, Okay, so that had to be given. Okay, let me just check what is now. Okay, so this is the last slide. Then we are through with that because then we come with the practical part.
Price band. The announcement before a workshop was to contain all the relevant financial ratios computed for both the upper and lower end of the price band, and also a statement for the attention of investors to the section titled Basis of Issue Price of Offer or Issue. The announcement and the relative financial ratios shall be disclosed on the websites of those stock exchanges where securities are proposed to be listed, and shall also be included in the application note of the respective websites of the stock exchange.
Okay, company has to give certain financial ratios in their prospectus. Okay, that's very important, and we are going to focus only on that after our next part of the session. Okay, I'm going to take you through a case study where all the financial ratios are published by the in the prospectus, so that the investors who are putting their money, they can make an informed decision about whether this is a good issue or not, whether it's highly priced or it's a price at a lower price. So analysts can make a complete analysis about whether the share price band is okay, is worthwhile investing or not. Okay, so the ratios have to be worked out, and it is worked out both on the upper band as well as the lower band, because we don't know at what price the company is going to, ultimately the share is going to be issued. So all the ratios are worked out on upper band and lower band and advertised to the public. Okay, so this is called the basis of offer document, where the lead managers, the merchant bankers, and the company, they'll say this is the price what we have fixed after going through all the data of the company, past track record, as well as other companies which are in a similar, business. Okay, so they have to give a complete justification of the price at which they are offering to the public. So we are going to just focus on that, and that's the most important part of the merchant bankers. Okay, so that's it. So now, what's the time? So we meet at 35, 12:35.